course, I'm not happy with the increase because it's pretty much resetting us back to ground zero. But what we did right was, after acquiring the properties, really focusing on executing the business plan, cleaning up the property, cleaning up the units, filling it with paying tenants, qualified paying tenants, and increasing rents.
All right, everyone. Welcome back to another episode here on Action Takers Unscripted. Today, I have a guest. Her name is Vessi, and she has been in the real estate industry since 2017, correct?
Yes.
2017. I am not going to run my mouth and let you guys know who she is. I'm going to let her allow her to speak on what it is she does, how she got into the real estate industry, and just what it is that made her get into this industry. So, Vessi, welcome to the show, and I'm so happy that you're here and ready to get this conversation started. Can you go ahead and let the audience know who you are and just everything that I stated earlier?
Absolutely. And first of all, thank you, Arsenio, for having me as a guest. It's been great connecting with you, and I really look forward to adding value to your audience today. I'm Vessi Kapoulian. I'm the founder of Dream, Believe, Achieve Capital Group, a real estate investment firm based in Los Angeles, California. And I help busy professionals who are tired of trading more time for money and looking to create additional income streams, diversify their portfolios, and achieve tax efficiencies through investing in commercial real estate, specifically in apartments. My investment journey started a while back, and as I reflect on it, really started many moons ago, back in Bulgaria, behind the Iron Curtain. And that's when I think the seed of real estate was really planted in me, but it didn't quite germinate until many years later. But I say that because growing up, when people talked about investments, they often referred to hard assets, simply because at the time there wasn't really a developed stock market in Bulgaria. I eventually came to the US to study and took on the more traditional path of going to school and eventually grad school, then joining a firm and climbing that corporate ladder of success that everyone kind of painted for you.
Yeah.
A few years into it, I realized I was climbing the wrong ladder because as I looked up, especially senior management within my organization, I saw how a lot of people were trading more time for money, constantly having to juggle and battle between spending time with family and loved ones versus being in the office or on the road, traveling for work. And especially for women, that's even harder. And then alongside with that, there were a few events that transpired. So I guess the clues were all around me. It just took me a little bit longer to pick them up. But the '08 crisis, which left a lot of people either without retirement or without a job or both. And then my own employer going through a couple of restructures, and the first two I survived. And that's when the light bulb went on, and I got thinking, wow, this is all great. I'm enjoying what I do, but what if I'm next? Or what if when I retire, the stock market crashes and my portfolio is decimated? What could I do? I can't control global geopolitical macroeconomic events. I don't control the decisions that my employer is making when it comes to restructures and such. But what I can control is how I plan for retirement. And in those moments of crisis, I think people tend to resort to their habits. And not that it was necessarily a habit at the time, but when I thought about it, what could I do that would provide me that safety for retirement, I thought of real estate. And that was the first thought, and that's how it started. I took a very small first step, which at the time felt very scary for me, because I thought, well, I'll just buy a single family home. It will bring me some income over time. It will appreciate in value. So by the time I retire, I have something to fall back on. And that first investment did really well, which prompted me to buy another and another. And then the light bulb went on again. And I realized, wow, this is not just a small retirement nest egg. That could be something bigger that can eventually even replace my W-2 income.
Mhm.
And as I thought about how I scale that further, multifamily emerged as the next natural step for me for a couple of reasons. One, I could apply the experience and knowledge I had gained investing in residential real estate into multifamily. Even though they're two different asset classes, there's still some similarities. But secondly, my W-2 job was a commercial lender. So even though my experience as an investor started in 2017, my experience as a lender was far longer than that, 15 plus years. So I could leverage a lot of that knowledge and skill set in terms of analyzing deals and apply that into the multifamily space. So I made that decision and I have been staying in that lane for the past couple of years and really enjoying the journey, not only for personal and professional growth, but also the ability now to help others take advantage of the benefits of real estate.
Yeah, I think that's a incredible story, and what you would, because you're from a different country, right? And you
Yes.
come into the U.S. for the opportunities, education, whatever the case may be. I've had another guest who was from Russia, same kind of similar path, came here for the opportunity, and you seek those opportunities and realize that real estate
Mhm.
offers you the time, offers you the opportunity to get control back over your time and get some control over your finances. And
Mhm.
it's basically a vehicle to get you from your W-2 job into the wealthy part of being a real estate investor. So I enjoy that, and I enjoy that story, and I enjoy hearing folks from other countries doing this when we have people who lived here for all their life still working at W-2. And don't get me wrong, it is nothing wrong with working at W-2.
Mhm.
Some people that's just, they love their job, they don't want to quit, and that's fine. It's just, how do you get that time back? Can you get that time? Do you have to continue to work until you're 65, or some have retirement accounts, the IRAs accounts, like the military? We have a TSP, what we call a TSP, and we don't have to, but we can pretty much put money into the TSP and can't touch that money until 59. Do you want to continue to do that? Like, no, you want to take back that time and get back and take control of your finances and touch the money whenever you can, put that into something else and continue to grow. And I really enjoy and know that real estate is that segue to get us to the point where we're free. You want to be free. You want to be able to do these things and not have to rely on your W-2, because a W-2 can only offer you a certain amount per quarter, per month, whatever the case may be. But real estate, it really does open many, many doors and opportunities for you to do pretty much whatever you want. As long as you set it up the right. Well, and I'm sure you've had many stories, setbacks, some obstacles you had to overcome in order to be where you're at today. But let me go back into when you started your journey into real estate. So you say you were a commercial lender, right? And you
Yes.
saw the opportunities that real estate could provide for you.
Mhm.
You did you start as single family in the single family housing and then move into multifamily? Can you kind of share how you started in the single family and then transition into the multifamily space?
Yes, no, that's a great question. I did start in the single family space, and I guess with at least in my own journey, usually how I start a new venture is first of all start small, methodical, learn the process, build the systems and processes, and also educate myself before I take the next big leap. So I started with something that felt a little bit more familiar and something that I could directly control, and that was a single family home. I live in Los Angeles, and my investment objective was to also invest for cash flow, not just appreciation. It was important for me to have a cash flowing asset that I don't have to subsidize on a monthly basis. So between that and the regulatory environment, coupled with the fact that the price points here in Los Angeles are quite high, let alone if I wanted the property to cash flow, I would have to either buy it all cash or put a pretty substantial down payment. So I didn't necessarily have those resources or that access to liquidity. And that's what eventually pushed me to look out of state. I was determined to start my journey as an investor. And so when I looked around, that was really the only option that made sense for me at the time. And from that point on, I dove deep into educating myself. Yes, I had the background as a lender, and I feel like as a lender, you're always thinking about the risks and the downside and how you protect the downside, which is great experience and thought process to have. As an investor, you usually think about the upside, or how do you make this investment flourish and maximize your return. So you think about the upside. So there was definitely a transition for me to embrace and learn also the investor side of the equation and the operational side. So I started connecting with a lot of investors here locally in LA through various meetups, online forums, got into bigger pockets as well, and really started learning, educating, reading a ton of books. And at one of those meetups, one of the people there was a frequent presenter, and he talked a lot about investing out of state, and he would say, well, if you have a question, call me. So one day I picked up the phone and called him, and I asked, hey, you talk a lot about investing out of state. Do you know someone who has properties for sale? And luckily for me, he did. So before I knew it, I had made a decision to invest in one of the properties he offered that happened to be in Memphis, Tennessee, which was great because I had visited Memphis previously. So I had, oh, you are in Memphis?
Yeah, so I'm not in Memphis, but that's where I started my journey in Memphis.
Oh,
too.
really?
Memphis is like the cash flowing, right?
Yes.
Not so much on appreciation. They're not big on appreciation, but cash flow, that is,
yes.
I think that's a best place to start in Tennessee. One of the best spots to start in Tennessee if you're looking for cash flow. But go ahead, please.
Absolutely. No, I could not agree with you more. And I didn't know it at the time, but I didn't really want to get caught up in analysis paralysis. So he had a home in Memphis. I figured that's where I'll invest. I'll look no further. The market made sense to me after I did my preliminary research. For that very first investment, I actually flew down there to meet with my real estate agent, with the property manager, the check on the home, drive around the neighborhood, just to get a better feel beyond the publicly available and online information one can obtain. And yeah, just took action. And that today, that property is probably my best performing one in terms of dollars per door or cash per door. And it went well, I think, partly because of me taking that calculated risk and that thoughtful step forward. And before I knew it, I started accumulating properties, and that's when I hit another crossroad, thinking, "Wow, if that income stream can be additional income stream in addition to my W-2." And can potentially replace my W-2 income, I'll have to buy a lot of homes before I can do that. And doing that alone is very challenging. One, due to lack of capital, but two, time and efforts. And that's what really led to the decision to transition to multifamily, where I have ability to partner with others, not only on the capital side, but also in terms of time and skill set. Scale up that way. When I decided to make that transition, to answer the second part of your question, I resorted to my formula: education and connecting with like-minded individuals. So took a deep dive again and joined a mastermind group, which is really how I got connected with my now partners, figured out how I can add value to others. And for me, that boiled down to analyzing deals. Initially, I was focused on acquisitions, also finding deals, but now I've transitioned more on the underwriting and capital formation side of the equation. and then building relationships. So once I identified what are my superpowers and how I can add value to others, then it became a matter of taking action, connecting with other investors, and making my message clear in terms of how I can help them. And from those conversations, the partnerships, I would say, emerged organically and naturally, and it's been a great journey. So I look forward to growing and helping others from here.
Yeah, that's what it's all about. That's why, and again, another point in multifamily versus single family house. Single family houses, you can do it by yourself. Once you're out of state, you kind of got to rely on other people, of course. Case in point, I do the same thing. So you got to rely on other people to take care of the property because you can't be boots on ground all the time. You're the property is like 1,000 miles away or whatever, however many miles away from where you're living. So being an out of state investor, you have those challenges and those setbacks where I can't. They're not going to take care of the property as much as I can, so I have to kind of rely on them a lot to take care of the property for me. But it's just you and that team, and just you kind of get a little sense of, okay, maybe I can rely on other people to take care of a property for me. And that's when you start to get to, okay, I can get another property. I can purchase another property, another 3-bedroom, 2-bedroom, or 2-bathroom house. Okay, I can continue to do this, but at what point do I, run out of capital or run out of equity or don't have enough equity to continue this? There's going to be some points where you stop. Some people, they continue the single family housing project, and that's all well and fine. But multifamily, you rely on a team and a set of skills that each individual brings to the table. And it's different skills, whether it's underwriting, capital raising, investor relations, whatever the case may be, getting those people together. And not only is it at the same location, so you get single family housing, it's different addresses, right? But with multifamily, you have one address with big project that multiple teams get together and invest in this big asset. You're just investing in a one single family asset in multiple different addresses. And that's the concept that I think about when it comes to multifamily. And again, it's a team sport. So it makes it like you're not doing it alone. You're not so much as it can be, maybe sometimes it can be a little stressful, but it helps when you have a team of individuals who have their own sets of skill and can help you out on this deal and make multifamily just an incredible asset to invest in, and just even more fun and make you want to do more deals and get bigger in the scale and just continue on forward. So did you start your multifamily projects in Memphis, Tennessee as well, or in Tennessee? I'm assuming in Tennessee as well. Or did you scale and go to other states or even in California? Because, California is something else.
No, for sure. Over time, I had diversified my portfolio. So I have properties in Tennessee, and eventually I expanded into Florida. So as I started my journey, initially I decided to focus on the Florida market in terms of acquisitions, and eventually that's where I got my first multifamily unit, which was a joint venture. So it was a small 11-unit property. I will say over the past 12 to 18 months, the Florida market has become more challenging. Of course, rates have increased everywhere, but insurance there has increased exorbitantly. And in addition to other expenses, and rents are normalizing, so you have cash flow compression. And really the only way to manage returns as you think through the equation is purchase price. And while prices have moderated relative to the peak of 21, 22, the cap rates, and while cap rates are increasing, they're not increasing or have not increased as rapidly as interest rates. So there are still some eager buyers, I guess, or enthusiastic buyers, which is why sellers are still pretty firm in terms of their price expectations, albeit, like I said, adjusted. But they haven't adjusted enough to a point where the numbers make sense from a return perspective, at least makes sense to me and my investor base. And that caused me to pivot. So my next holdings were in the state of Georgia, Savannah, Augusta, where I was able to partner up with a team who's already has established operations there, vertically integrated, a good track record. So everything checked out: the people, the market, the deal. The only thing that didn't make the list was, oh, it's not in Florida. But at that point, that wasn't necessarily a deal breaker for me. So I decided to jump in and help. And that's how I did my first syndication. That was in Augusta, and now the second one in Savannah. So since then, I've expanded into other markets, and now really how I evaluate each opportunity, it's really predicated first and foremost on the operator. Second, on the market. I would like to ideally still stay in the Southeast because I don't want to be spread around too thin around the country. But if I find a really strong operator, and lastly, the deal, so operator market deal, but if I find a really strong operator in a market with good fundamentals and a solid deal, then there's a little bit more flexibility there. But as long as those three parameters are met, operator, market, and then the deal or the numbers, then for me, it's just a matter of moving forward.
Yeah. Would you say I'm pretty sure. So your skill as a commercial lender for 15 plus years, right? Would you say that really helped you find out what your niche was as far as your skill asset to multifamily projects? Not only multifamily, I'm sure it's single family on into multifamily projects. It helped, accelerate your skills or enhance your skills even further as a multifamily investor or multifamily. You're a capital raiser as well?
I also raise capital, yes.
Okay.
But yeah, definitely it helped because as a lender, as you think through deals and investment opportunities or deals rather, you usually think about the downside, and as an operator, you usually think about the upside. So there was definitely a learning curve that I had to go through as an operator and try to balance the two. I still consider myself probably a little bit more conservative, and I know a lot of people use that word, and it could mean a lot of different things, and we can definitely dive into what that means to me in terms of underwriting. But having that foundation as a lender was definitely helpful, not only in terms of analyzing deals, but also having familiarity with the diligence and the closing process, what reports are relevant, why are they relevant, how to read them, how to navigate through the various documents. Even reading through a PPM, I wouldn't say it's a pleasurable reading, even to this date, but having the lender experience and plowing through thousands and thousands of loan documents, legal agreements, and transactions certainly helped me be better equipped in terms of how to read those, what in reality is pretty complex documents, and how to plow through that information and really figure out what are the important points that I need to know and how can I quickly find them. So from that perspective, it was definitely helpful. And then post-close, once you are managing a deal, there are certain compliance requirements that you need to adhere to as a borrower. So having familiarity, again, from the lender side, what to expect, whether it's reporting requirements, covenant compliance, some of the terms, even navigating through term sheets and what's negotiable or not negotiable, that experience has been priceless.
Two questions based on what you stated in regards to you getting into the multifamily space and the market itself. One, what type of asset class do you look for when it comes to multifamily? And then two would be in regards to the market now versus 2017. It's way different than it is, and no one would have expected for it to jump, the interest rates to jump as high as it is today. What are some strategies that you utilize when it comes to the market it is right now, how it is, and then how does it change, or maybe how do you adapt to this ever-changing market that we're going through right now?
Yeah, so regarding the first question, in terms of asset class, I focus on the active side. I focus on multifamily, specifically Class B, C plus properties, preferably 1990s and newer, stable value add, so no heavy repositioning, around 150 units plus or minus, and in strong markets or markets with strong fundamentals. That's really the buy box, and the last couple of deals that I've done have been pretty much in that parameter. In terms of the current market, I could not agree with you more. I don't think anyone could have foreseen how much and how rapidly rates would increase. And I don't think anyone has been there on record predicting the exorbitant increase in insurance that we're seeing. And certain states like Florida, Texas, coastal areas have been more impacted than others, but I'm seeing even in some inland markets or Midwest where insurance companies are now becoming even more stringent as they are evaluating properties, and had fellow colleagues just the other day talk about how their insurance got dropped on an older asset that they own. So I don't think anyone could have predicted or foreseen these challenges. So how am I navigating through those? First of all, it's adhering to fundamentals and fundamental underwriting principles. Inevitably, once you are managing a deal, it's like running a small business, right? Inevitably, unexpected things always happen, but before you enter into a deal or a transaction, I'm always thinking through what are the various risks and how am I mitigating those risks? Specifically, when it comes to interest rates, historically, I've always done fixed rate debt, including on the multifamily transactions that I'm in, because I'm not in a position to forecast rates. I don't know where they will be. And while it is more expensive to lock in a rate on a risk-adjusted basis, it enhances the transaction. So from a interest rate risk perspective, that's how we've mitigated that exposure. Insurance, nobody could have predicted, but that is why you also want to have ample reserves. And that's where I see maybe some people getting a little bit more aggressive, or at least from my perspective, a little more aggressive by perhaps not raising sufficient capital upfront for that rainy day fund, such as operating reserves, because that's the cushion that can help you absorb any short-term compression in cash flow or potentially even negative cash flow if or when those unexpected events were to occur. So really adhering to fundamentals, the underwriting as well is adjusting some of the assumptions to moderate some of the rent growth, making sure all the expense adjustments specifically related to taxes and insurance, but of course looking through other items are properly adjusted to account for those potential increases. And last but not least, modeling the cap rates. I see a lot of deals that were closed with loan assumptions, at 3-4% rates, which is great. But if you're modeling a 3.5-4% exit cap, that to me is a little bit more aggressive, because I don't know if rates would be there in the next couple of years.
Right.
So making sure that modeling that exit cap rate as well is properly accounted for upfront. So I hope that answers the questions, but it really comes down to doing all the upfront legwork and diligence. I like to call it measure twice, cut once type of approach. And I can definitely speak through navigating through ongoing challenges once a deal is under contract, but I hope that answers the second part of the questions in terms of how I've adjusted or navigated through some of the current market challenges.
It absolutely does. And it comes down to, like you stated before, doing that proper due diligence. And I think in this type of market, you kind of have to be conservative. Not kind of. I think it's a must. You must be conservative. I know some people got caught in the multifamily projects, unfortunately, with not knowing the interest rate was going to jump from 3.5% to all the way to 6 within a matter of months, within a matter of a year. So having those reserves as well, as you stated, is key and important as well, because if you don't have those, which some of those folks did not account for that, now they're caught with their vans out, and now they have to sell the multifamily faster than what they intentionally had, causing their investors to either one, lose capital, or causing themselves to lose capital. And now they're losing credibility, unfortunately, due to market increase and them not planning for this type of deal and not having enough reserves to cover them and cover their investors. So I like what you said there. And I think it really, underwriting is very, very important in this type of market. And being a conservative underwriter is really key. Do you have any projects where you stated you had some cases where the market, you had to adjust some things, or some obstacles came in the way where you had to adjust? Do you have any stories in regards to your multifamily projects that you can share that you overcame or that you continue to struggle with to this day that you can share with the audience in order for us to, maybe navigate some of the ways that we invest in some of our projects and give us some strategies to, overcome those type of obstacles? You have any stories you want to share?
Absolutely, yes. I can maybe talk about one of my existing properties, and it really boils down to, it's probably a good story in terms of how some of that preliminary diligence has worked out in our favor. But I mentioned insurance, and the first property I acquired along with my partners, it's a small 11-unit joint venture in Florida. So inevitably, we were on the receiving end of the insurance increases where our premium pretty much doubled, almost doubled, I would say, year over year. We did not see that coming, and I don't think anyone else did that. But there are a few things that worked in our favor. Of course, I'm not happy with the increase because it's pretty much resetting us back to ground zero. But what we did right was, after acquiring the properties, really focusing on executing the business plan, cleaning up the property, cleaning up the units, filling it with paying tenants, qualified paying tenants, and increasing rents. So really that focus on operations on the front end is giving us a ton of cushion to absorb the increase on the expense side of the equation. And then having ample reserves. Some people, again, may say that we reserve too much, but it's if anything, the recent events are proving to me that being more conservative from that perspective is helping us to, quote unquote, absorb this short-term shock, if you will. We'll see what next year will bring in terms of increase, and we certainly have relationships with a number of brokers, but I don't think that's necessarily predicated on brokers' ability to get insurance rate. It's really better insurance rate. It's really driven by the market. And unfortunately, the entire state of Florida is struggling quite a bit right now, including the insurer of last resort, Citizens, which in recent articles announced that they're not in a position to absorb all the losses if all of a sudden a natural event was to hit. So they're currently looking to offload some of their exposure to private carriers, but a lot of private carriers have actually exited the market. So I'm really not quite sure what the solution is there.
Yeah.
So for us, it's really focusing on operations, making sure we maximize the occupancy. And currently we're at 100% occupied. So very grateful for that, especially for a smaller property like that. Maintaining 90% or above occupancy is critical, and then minimizing the expenses to the best extent possible without necessarily sacrificing our obligation to the tenants, such as repairs and maintenance and ongoing support.
Nice. I like what you shared there. That was, again, with a small multifamily deal like that, it is important to keep that occupancy up to at least 90%, 95% if you can, if you will, just because that one believe it or not, that one tenant that leaves, it could be detrimental to the funding of the business, because real estate, it is a business. Real estate investment, it is a business once you get into it. So, but yeah, you just got to make sure you're operating and make sure that the numbers are working for you in that case, and getting the tenant in as soon as that tenant is out, doing the renovations on the space and doing whatever it takes to get another tenant in there in place of that tenant to replace that income again as fast as possible is important as well. I want to go ahead and segue into the final part of the show. I've been enjoying this conversation. I know we're running short on time, so let's talk about your company, and then any final words or thoughts you want to give to the audience, and then finally just share with how people can connect with you and your company if they want to either reach out to have a conversation or reach out and invest with you and your company.
Absolutely. And I would like to offer a complimentary gift to your audience. I have a digital book, The Busy Professional's Quick Guide to Investing in Multifamily, which people can download on my site, and I'll share that in a moment. But happy to share that complimentary gift with your audience. Other than that, in terms of my company, to answer your first question, yes, I continue to focus on multifamily. I think focus is incredibly important. I share a ton of educational content with my investor community, as well as publicly, particularly on LinkedIn, really in an effort to create better educated and more empowered investors. Because again, I think education is power. And when you combine education and knowledge with action, that's incredibly impactful. In terms of how people can connect with me, it's the easiest way is really through my site, www.dbacapitalgroup.com. D is in dream, B is in believe, A is in achieve. My phone number, email are there, direct link to my calendar for complimentary call, as well as that's where people can download a complimentary copy of the book, so they can be better educated and more empowered investors.
Right. Awesome. I will definitely ensure we include that in the show notes. Dream, believe, and achieve Capital Group. Vessi, thank you so much for coming on the show again today. I truly enjoyed this conversation, and I'm sure the audience will as well. And I look forward to even having a further conversation, and maybe even have you on as a second time guest in the near future.
I would love to. I really enjoyed our conversation, Arsenio, and thank you once again for having me as a guest.
Absolutely. Happy New Year to you, and to the audience members out there. Let's get out there and take action. I truly enjoy each and every one of you. Thank you for coming on today and listening to Vessi share her story, and listening to myself again this week. It's like, God, we keep hearing this guy, Arsenio. He keeps talking. But no, I sincerely do appreciate each and every one of you for tuning in today and listening to Vessi share her story. All right, Vessi, this is it for us. Thank you again.
Thank you.